So in summary then, what we're going to do here, what we did here, is we're dealing with the statement of cash flows. And the statement of cash flows has 3 sections. And what it does, and by the way, you guys don't forget that, yeah, you're on YouTube.
I'm just sending the picture to his phone because it's.
Oh, I know, but the voices are on YouTube. All right. Anyway, here, first of all, you figure this cash flow from operating activities. Then the next section, cash flow from investing activities, cash flow from financing activities, and here you reconcile the cash. So what happens here now is the fact that you start out with, and so what happens here now is cash flow from operating activities. So in this case, things like cash from customers, cash paid for merchandise, cash paid for wages and operating expenses, cash paid for interest, cash paid for taxes. So $20,000 worth of cash came in from operating activities. Investing activities, now this is buying and selling assets, and it's cash in, cash out. So in this case, cash received from the sale of plant assets, cash in, cash for the purchase of plant, cash out, a $2,000 net cash in. Financing activities, now this is when you buy and this is when you sell stock or reacquire treasury stock. This is where you borrow money or pay off debt. Now the principal will show up down here as a financing activity. Interest, which is on the income statement, shows up as an operating activity. Okay, and then okay, all right. In this case, you issued stock for $15,000. You retired. You paid off $18,000 of principal of a loan. You paid $14,000 in cash dividends, so it's a net cash decrease of $17,000. So $20,000 in, $2,000 in, $17,000 out, a net increase of $5,000 in cash. So in 2010, our cash balance was $12,000. Okay, that shows up right here. We have $5,000 of cash in over the course of the accounting period, so the ending balance is $17,000. That shows up right here. Okay, so this explains the changes in the cash account. All right. Now, there's 2 different ways to do the cash flow from operating activities. There's a direct method, which is this one. It's only used by a small percentage of companies. Everybody else uses the indirect method. Here's the indirect method. The indirect method will start out with your net income, and it will convert it from the accrual basis to the cash basis. So if you have an increase in accounts receivable, as happened here, so accounts receivable were $40,000 last in 2010. It jumped up to $60,000 in 2011. That means there's $20,000 worth of sales that have not been converted into cash. They've not been collected. If they've not been collected, you take that $20,000 out because they're from a cash standpoint, there's not a sale. Your merchandise inventory, it went from 70 to 84. That means that your cost of goods sold is understated by $14,000 from a cash standpoint. Okay? Let's go down to accounts payable. Accounts payable went from 40 to 35. That means that you paid off some of last year's accounting payable in accounts payable in this accounting period, so you subtract that amount. Okay? Depreciation expense. Now depreciation expense, you subtract it, you take it, you add it back to cancel it out. Because depreciation expense is an expense that involved no cash, right? All you did is you estimate you're building your car, something wore out that amount. But there was no $24,000 check. Okay, it was $24,000, right? There was no $24,000 check, it's only an estimation. You cancel it out, you add it back to cancel it out. Loss on sale of plant assets, $6,000. What you did is your book value is determined by how much depreciation you claim. When you sell it at a loss of $6,000, it means you should have declared more depreciation. All of that's accrual accounting. All that matters is how much you sell your plant asset for, and that's the amount that shows up under investing activities. So when they sold the plant assets and got the $12,000, that's all that shows up. So you cancel out the loss or the gain or the loss in the sale, and you only report the actual cash, and you do that under investing activities, right? And then the same with retire of a note. So when you retire a note, you compare the carrying value with the actual cash you received, so you receive this much less cash, that's accrual accounting. You cancel it out by adding back, by taking out the gain. If it was a loss, you would have added it back, okay? So that's by way, so, and then, so to kind of sum up, the way that works, of course, is the fact that, okay, and that's just by way of introduction. Now below this, what you'll have is you'll have non-cash financing activities. So if you buy a building with only a mortgage, nothing down, that's a non-cash investing activity. Report that down here. Report that at the bottom, okay? Now, you guys, that's pretty much it. We covered a lot today. Is everybody doing well? All right. So then